Hello and welcome back to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today. We started off in the first segment talking a little bit about the debt limit debate and what exactly it means to you as the average citizen, what it means to us as a country. And make no mistake that it is not a good situation we're in. It's possible painful to the average citizen as well as collectively as a country. But what I don't like to hear is this default on the debt. The U.S. Treasury has more than enough money coming in to pay the debt, and so we see the default on the debt as extremely unlikely. What will happen if the debt ceiling is not raised, the government will have to start prioritizing payments, just like you do in your household. Your income comes in, you prioritize what you're going to pay, your mortgage, your light bill, your food, things like that. Well, the interest on the debt is one of those priorities that will continue to get paid. There's other payments that may get delayed for a while they sort this out. But it's my feeling that as the deadline looms and the pain to the average citizen becomes more and more apparent, that some sort of compromise will be worked out. It's kind of the way that Washington works all the time. The conventional wisdom has been that we need a couple weeks before this August 2nd deadline in order to get the legislation through, to get everything passed. That although this would be the preferable scenario, I also think that if some last-minute deal is reached, that they will do what it takes to get the legislation in place to make sure that this compromise is legally set. If the U.S. were to come to a default, you would see interest rates rise significantly. The AAA credit rate in the U.S. would go away. But once again, we're not seeing that in the bond market. The bond market, the rates would gradually increase, as we're seeing with Greece and Italy and Spain. The rates in those countries is going up, where U.S. Treasury, the yields are actually falling. And so this is an indication that at least the bond market does not feel like a default is very likely. So what is the impact for investors? For the short-term traders, I don't know, because we don't do short-term trading. I don't really know what that has. But for the long-term buy and hold investors, the ultimate confidence in the U.S. government to be able to repay its obligation in long-term Treasury bonds should still be there. That at this point, any dramatic change in investment strategy is probably not warranted for most investors. Now, Bill Gross, who manages one of the largest bond funds in the world, has moved away from U.S. Treasuries, but that was mostly, I don't have an inside line to Bill Gross, but publicly stated, there is some concern with the credit worthy, but a lot of it is valuation, that the Treasury bonds have become overvalued and he's finding better value in different areas of the fixed income market. But the fundamental demand for U.S. Treasuries has remained strong. Yields are still remaining low. This is due to a couple things. One, the confidence that the debt limit will be raised. The weak economic data, most people make a choice between stocks and bonds, and when you have weak economic data, people tend to go towards Treasuries. Paradoxically, this whole debate on the debt ceiling and budget spending cuts has made a lot of people think that the U.S. will emerge much stronger from this than they were previously, and I happen to tend to agree with that. And so there's a positive sentiment for U.S. Treasuries, that this budget debate will end up being a net positive for the U.S. Let's move on and talk a couple things about the dollar. Two big questions we get for the dollar is there a risk the dollar collapsing in the short term? And number two, is the world going to abandon the dollar as the world reserve currency? And so on the first question, the answer is probably no. That when we look at moves in the dollar, in fact, as global crises continue to hit the world, we see that the dollar rises every time. Just next time there's some crisis, look at the value of the dollar, and the value of the dollar rises. Also, when you think about currencies, it's all relative. Unlike a stock, Coke can be worth $50 and it can go to 100 or it can go to 0 on its own, independent of the market. Well, currencies are all relative. And so when you hear, the dollar appreciating, it has to be appreciating against something else. The euro, the yen, something like that. If the dollar's declining, it has to be declining against something else. So it's all relative movements. And no one in the world is going to benefit from any short-term sharp reduction in the value of the dollar. And so we just think it's a very unlikely move. The world is so dependent on the dollar that no one wants these violent moves in the dollar. Most commodities are priced in dollars. Foreign countries have billions and billions of dollars of foreign currency reserves in dollars, and so no one wants that to happen. The same thing with the dollar losing its world reserve status. It's just not going to happen anytime soon. No other currency currently can exist that can offer the stability and liquidity to replace the dollar. Now, mid to long term, however, there is a possibility that the dollar will eventually share its reserve status with other currencies, maybe the euro, the yen, or even possibly the Chinese. But in the short term, we don't think the dollar is going to have a sharp decline, and we don't think it's going to be replaced as the world's currency. So that brings us up to our next break. We'll continue with this discussion when we return. For All Things Money, I'm David Blain.